Hello, folks. Welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is on one of the top performing sectors within the U.S., right? The consumer discretionary sector. One of the most interesting sectors in my opinion. Right? It has everything going on right now. Some really good, some really bad. Let's jump right in. Let's take a look at that. What am I talking about here? I want to focus in the lower right-hand corner here, ladies and gentlemen. Right? These are the year-to-date returns excluding dividends. Right? They do not include dividends. Only price returns here. The S&P is flat on the year here, right? Minus 20 basis points. The S&P is flat, but a sector within the S&P here, consumer discretionary, is up over 12%. Right? So flat versus 12%. Now the overall NASDAQ, that is at 17%, the tech-heavy NASDAQ. So you can see consumer discretionary is behaving much more similar to NASDAQ than it is the S&P 500. All right, we haven't even gotten into anything interesting so far. Let's drill down. Within consumer discretionary, we got four subcategories here. Right? Take a look at these, boys and girls. Retailing's up 30% on the year. That's what's driving the overall return of 12. Right? One area is up 30, while the other area, the worst performing area, is down 24. All right, so let's run through these here. The retailing sector, of course, Amazon is in this category, right? That's the 800-pound gorilla here. Then we have consumer durables and apparel. All right, I believe Nike is the biggest company in this one. Then we have consumer services. This has your McDonald's, all your fast foods, the Starbucks and the coffee chains, all the hotels and so forth, down 21. And of course, you know the autos. But look at the tremendous difference here. Look at the difference, right? If you're going to get off the porch, you might as well run with the big dogs, right? That's the way I look at it. And so what's interesting in consumer discretionary is not the entire sector. Not the entire sector by any means, right? I am a huge fan of passive investing. A huge fan in general. Whether it's passive indices, right? Passive investing at the index level or at the sector level, or style, value versus growth, or size, small, medium, large, right? Normally, I just chase passive funds. I like them. Now is not the time to do it. You saw it just a minute ago. Within the consumer discretionary sector, one's up 30, one's down 24. The difference, for the most part, is the quality of the balance sheet, right? So if you buy an entire basket, like you do with a passive fund, if you buy an entire basket, you're buying the good balance sheets and the bad balance sheets. You want to think, for a short period of time now, you want to think about just focusing on the good balance sheets. To do that, you got to be thinking about smart beta ETFs or some active managers to take advantage of that. All right, so keep that in mind. That's going to be huge going forward. All right, so why is that? Here we have the price relative, or the cross price of the consumer discretionary sector in the S&P 500. So the way this is set up is when we're going down, it's when consumer discretionary is cheap relative to the S&P 500, and when it's going up, like it is right now, is when consumer discretionary is very expensive. In fact, we are just off of our all-time highs here, right? We are in nosebleed territory right now. So everything's expensive right now. And if we're going to overpay for something, we might as well overpay for something in the right area. Again, you're looking for growth. You're looking for quality of balance sheet. Those with pricing power. Those that can maintain profit margin. Think about this, right? Here's our backdrop today. What's the bond market telling us today? Read the tea leaves. It's not real complicated. If you look at the slope of the yield curve or the level of interest rates, long-term interest rates, in the U.S. and out of the U.S., right? What's the bond market saying? Subpar growth is going to be here for a long period of time. Subpar growth is going to be here. We have to get used to it. And so far, there's been very little delineation between the good balance sheets and the bad balance sheets. That is most likely going to change going forward. So we have to focus on that much more prudently going forward. So within retailing, right? Retailing is a hot area within consumer discretionary. What is hot within retailing? This is going to come as a shock to no one. Take a look at this, folks. E-commerce. E-commerce. Here's the big one. E-commerce has increased market share. All right, here we're talking about penetration or market share. Increased market share 5.5% just so far this year. 5.5%. Today, the way to read this is a little over $1 in every $5 spent by the consumer. All right, this is for retail sales. $1 in $5 is online. It's e-commerce. That's a huge move. 5.5% in a small portion of a year. Before then, of course, it took 5 years. It took 5 years, and we still didn't quite get to 5.5% penetration growth. All right. So a lot of this, of course, has to do with the virus, right? They forced us into e-commerce. So if we were in e-commerce, they forced us to expand. For those that weren't in e-commerce, due to the social distancing measures, you had to learn how to do it. That explains it. But today, we're still only at $1 in every $5 spent on retail sales. How high could that go? Certainly, 2 and 5, 3 and 5, 4 and 5. We really don't know at this point. All we know is the likely outcome is definitely north of here. All right, so let's keep drilling here. If e-commerce is the future, who are likely the major benefactors within this space? So I kind of group these into 3 categories. Pure e-commerce firms, right? These are the Amazon, Shopify, eBay, Etsy, Wayfair, and so forth, right? The pure plays. Then there's the sort of the behind-the-scenes plays within the grocery industry, because what we're going to see is within e-commerce, the hottest area is in the grocery side of things. All right, so the behind-the-scenes plays here are Instacart, Ocado. This is a UK firm. If you're not familiar with it, if you're not familiar with Ocado, you should get familiar with it. I seldom ever talk about individual companies on my show here, but this is a company you need to take a look at. Those in the grocery industry, sort of behind the scenes, and of course, all the traditional retail grocery chains are also trying to get in this category, right? They want to build out their own digital platforms, the Walmart, Kroger's, etc. Again, I've already told you the punchlines. We started it at consumer discretionary. We went to retail. Within retail, we went to e-commerce. Let's drill down another level. Within e-commerce, what is hot? Well, it is the online grocery. Right, here we go. Online groceries growing a staggering 600% in a year. That is amazing. And again, we all know that at least some portion, if not a big portion of this, was due to the virus. Yeah. But check out this survey result beside it. 90% of the consumers that have now used it, whether they were forced to or they voluntarily did, 90% plan to continue using it. That massive growth is expected to continue. I kind of doubt whether or not we're going to maintain all 90%. That would be a huge number. But if we maintain any growth numbers like we're seeing today, wow. I mean, the upside is really just unfathomable at this point. All right, let's look at some of these other numbers here to try to put this in perspective. All right, let's try to look at some pre-virus, right? Let's go back to August. So we got a very clean pre-virus date here. We had sales at 1.2 in August. In June, they're estimated to be 7.2. 1.2 to 7.2. What a change. We are talking exponential growth here. Orders from 16 million to 85 million. This is just mind-boggling growth in this space here. It's not only mind-boggling growth, right? The industry itself is changing in very interesting ways. When this thing started, there were very little barriers to entry at all. It was almost ridiculous, right? I pick up the phone, I call it in, and then Kroger has a professional shopper, and they fill a cart, and then someone brings it and delivers it, right? It was very operationally inefficient, very labor intensive. That's not what we're talking about anymore. That has been tried, and for the most part, it's been unsuccessful. What we're talking about today's world, the barriers to entry are high, and they are growing very quickly. Now, these barriers are particularly high in the U.S. here, because we're still going to need individuals and, of course, the labor costs in the U.S. So what are we talking about here? Why are the barriers so high? Well, first of all, it has to do with how fussy we are, right? We put our order in and we expect that order to be filled correctly. We want our produce and our meat products to be fresh. We want it delivered fast, right? We want. And, of course, we get easily pissed off if none of those things come through. So that is the biggest thing. That is your biggest barrier to entry there. On top of that, of course, warehouses need to be built near the population center. Because, again, we're not talking about a physical shopper competing with the other shoppers in Walmart to fill your online order. We are talking about these being filled at a separate location now, at a separate warehouse that is nearby, right? It has to be nearby the population center. It has to be, nearby these other facilities as well. So the cost in the spacing of these warehouses. But of course, we still need the individuals, the last mile. Somebody, we need reliable people that are willing to fill this role. And again, the reliability is non-trivial here. And then, of course, we need enough consumers to make the economics work. That was a problem the first time around, when it was so labor intensive. When I picked up a phone and somebody went and got the order and another person delivered and so forth, it was just so slow and labor intensive. And the quality, of course, was hit and miss. All of that is slowly going by the wayside. So the barrier entries today are high, and they are just going straight up here. This, I mentioned that firm Ocado before. This is a couple snapshots from Ocado. And what they're doing is really, really interesting stuff here. This is automation we're talking about that takes years to build, right? That's why the barriers to entry are so high today. The automation just takes years to build it. Of course, it's very expensive. We're talking about a lot of artificial intelligence and machine learning. This area is really a core feature of the overall robotic revolution here. So what we're looking at here is a series of these containers. Of course, this might be your container, and then that's my container, and so forth. And these bots then fill the containers based on the orders that we send in. And then, of course, our containers are efficiently shipped to a delivery person, and they're delivered to us. Now, on the other side, of course, we have robotic arms that now can even handle fruit, right? They have the sensitivity that they can handle fruit. This is the level of technology, the level of innovation we're talking about going forward. So while everything is arguably expensive right now, right? Everything is arguably expensive, and the bond market is telling us subpar growth is coming, right? Think of it this way: if we're going to overpay, let's overpay for promising areas, right? And e-commerce obviously is one of those areas, right? It is one of the most interesting. And particularly, if you're not familiar with the UK firm Ocado, take a look at them, right? I'm really a big fan, and we don't even hold it in any of our portfolios right now. They don't fall in our space, but I'm still a big fan of theirs, right? Take a look at that one. All right, so that's our message for today. I'm Don Rich, and you've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.